There is a collection of bills either stacked somewhere in your home or being automatically pulled from your bank account at this very moment. And some of those bills you are no longer legally required to pay in full. Not because anything in the system has malfunctioned, not because someone stumbled across a clever trick on a website somewhere, but because the law itself established a protected category of individuals and quietly placed you inside that category the moment you reached the age of 65. The difficulty is that nobody whose entire job revolves around collecting that money from you is going to send you a letter of congratulations. The payments continue going out. The money continues leaving your account, and most people spend years, sometimes entire decades, overpaying bills they have not actually owed in full since their most recent birthday. What I am going to take you through today are 7 of those specific bills, one at a time, explained in straightforward language, with the precise action you need to take for each one. And I want you to stay with me all the way to the end, because the final 2 I am going to show you are the ones almost no one ever discusses. And for the right individual, those 2 alone can be worth more than every other item on this entire list combined. Before we get into it, let me be clear about what this video is and what it absolutely is not. This is not a collection of clever tricks. It is not some gray area workaround or questionable strategy. Every single item I am going to walk you through is an established program, exemption, or legal provision that already exists right now. It is already funded, already operational, and already has your name attached to it in some form or another. The only thing separating you from it is a form, a phone call, or simply knowing the right question to ask. And I want to address the 2 assumptions that cause people to stop watching videos like this before they ever reach the valuable information. Some people hear the phrase financial relief for seniors and immediately conclude it is reserved only for people facing serious financial hardship. Others assume it is only relevant for individuals with significant assets and complicated financial estates. Both of those groups are mistaken. For each of the 7 items we cover today, I am going to tell you precisely who benefits most from it, so nobody watching this can honestly walk away saying that part simply does not apply to me. Let us begin. The majority of people over the age of 65 are paying more in federal taxes than they are actually required to pay, and it is not happening because they are filing dishonestly. It is happening because 2 completely separate deductions built specifically for people their age are either being overlooked entirely or never applied in the first place. Here is how the tax code genuinely functions for someone who is 65 years of age or older. Every American receives a standard deduction, which is a portion of their income that the IRS has agreed not to subject to taxation before it ever begins its calculations. For 2025, that figure is $15,000 for a single filer and $30,000 for a married couple filing jointly. But here is the piece that gets skipped over constantly. Once you reach the age of 65, you become eligible for an additional deduction that stacks directly on top of that base amount. For a single filer over 65, that represents an additional $2,000. For a married couple in which both spouses are 65 or older, it is $2,000 for each individual, bringing the total additional amount to $4,000 stacked right on top of the standard deduction. And then beginning with the 2025 tax year, Congress introduced an entirely new layer on top of all of that, an additional senior bonus deduction currently set at $6,000 per qualifying individual. So a married couple in which both partners are over 65 is now looking at the regular standard deduction, plus the long-standing senior add-on, plus this newly introduced bonus. Add those figures together and you are looking at a very substantial portion of your income that the federal government has agreed should simply not be subjected to taxation at all. Here is the trap, and it operates quietly. The people this helps the most, the retiree living on a modest fixed income, filing a simple return themselves, or passing it to a preparer who is moving quickly through a busy season, are the exact individuals least likely to notice whether these deductions were actually applied to their return. No alarm sounds. No letter arrives in the mail. The return simply gets signed, submitted, and the money goes out the door. The action required here takes roughly 2 minutes. When your tax return is ready to be signed, before you put your signature on anything, review it and confirm that those deductions are actually present. If you are using tax preparation software, verify that your date of birth has been entered correctly, because that is what triggers the additional deductions. Then ask whether your withholding from your pension or your Social Security income should be adjusted going forward, because a significant number of people are essentially lending the federal government an interest-free loan every single year purely out of longstanding habit, and they have simply come to regard it as normal. Note that the $6,000 additional deduction begins to phase out at $75,000 of income for single filers and $150,000 for married filers. Please consult a qualified tax professional to confirm exactly what applies to your specific personal situation. Now, I mentioned at the very beginning that there are 7 bills on this list. We have covered the first one, and already, depending on your individual circumstances, we may have just identified hundreds or potentially even thousands of dollars that have been unnecessarily leaving your account. But here is where things become genuinely interesting, because the next item on the list is where the single largest dollar amounts are hiding. And it arrives in 3 distinct layers that most people have never heard of, let alone actually filed for. Most homeowners are only taking advantage of one of them, if they have applied for any at all. The first layer is the homestead exemption. Nearly every state in the country offers it, and what it accomplishes is the removal of a fixed portion of your home's assessed value before the county ever begins running its tax calculation. In some states, that amount is $25,000. In others, it reaches $50,000 or beyond. The specific figure varies from place to place, but the underlying principle is consistent everywhere. A lower assessed value produces a lower tax bill. And here is where people consistently get hurt. The homestead exemption is almost never applied automatically. It requires a one-time form that you submit to your county assessor's office. File it once, and in most states, it remains active for as long as you continue to own the home. Fail to ever file it, and you pay the full unprotected tax bill year after year for absolutely no legal reason whatsoever. The second layer sits directly on top of the first. It is referred to as the senior exemption, and it is an entirely separate application that becomes available the year you turn 65. Most counties that offer a homestead exemption also provide this one, and the county will almost never take the initiative to mail you the form on its own. You have to know to request it specifically by name. Here is what prevents a significant number of comfortable retirees from ever applying. They assume that because it is called a senior exemption, there must be an income test that they will not qualify for. But in more than half of the states that offer this benefit, there is no income test at all. Age is the only requirement that matters. You turn 65, you submit the form, and you receive the exemption. The third layer is the one the overwhelming majority of people have never encountered. And for a homeowner sitting on property that has appreciated considerably in value, it is the most financially valuable of the 3. It is called the senior assessment freeze. When you successfully file for a freeze, the county locks your home's taxable value at whatever figure it stands at during the year you apply. From that point forward, it does not matter how dramatically your neighborhood's values increase. Your neighbor's assessed value can climb by 40%. The broader market can surge upward aggressively. Your frozen number stays exactly where it was. You continue to be calculated based on what your home was worth the year you filed the application, not what it is worth in today's market. For someone sitting on a fully paid off home that has doubled or even tripled in value over the last decade, that freeze represents an enormous amount of money over time, not concentrated in a single year, but accumulated across 5, 10, or 15 years of suppressed increases. The savings compound into a figure that can genuinely take your breath away when you add it all up. And renters, do not go anywhere just yet, because this one touches you as well. Your landlord pays that property tax bill, and every dollar of increase that arrives gets passed directly into your rent. When property taxes are frozen or reduced across an entire community, the pressure driving rent increases eases somewhat. It is not immediate and it is not dramatic, but it is genuinely real and it does matter. Action step for this one. Call your county assessor's office this week. Ask them directly and by name whether the homestead exemption, the senior exemption, and the assessment freeze are currently on file for your specific property. If any one of those three is absent, ask what form is required to add it and what the filing deadline happens to be. That single phone call could very well be the highest dollar per minute conversation you have during this entire year. Here's the quietly frustrating thing about Medicare Part B. Because the premium is deducted automatically, a large number of people never even consciously register that they are paying it. They simply notice a slightly smaller deposit arriving and move on without giving it much thought. In 2026, that premium is running approximately $185 per month, pulled out automatically every single month without fail. But here's what almost nobody gets informed of. There's a family of programs called Medicare Savings Programs, and if your income falls beneath the qualifying threshold, your state will pay that Part B premium entirely on your behalf, not reduce it partially, cover it completely. There are 3 separate tiers within this program, and the most comprehensive tier does not merely cover the monthly premium. It also eliminates the majority of your deductibles and copayments. Take a moment and let that actually register. The income limits for these programs are considerably higher than most people assume. Many retirees see the phrase savings program and immediately conclude they earn too much to qualify, and a significant number of them are simply wrong about that. A growing number of states have also eliminated the asset test entirely, meaning the balance sitting in your savings account or the value of your fully paid off home does not count against your eligibility. Despite all of those facts, this program remains one of the most underclaimed benefits in the entire system. The required action is a single phone call. Reach out to your state health insurance assistance program, which is your local SHIP office. The service is completely free. They will screen your situation and walk you through the application process from beginning to end. That call, if you qualify, can return close to $200 every single month to your Social Security deposit. Across a complete year, that adds up to nearly $2,400 returned to your pocket. And while you have them on the phone, ask specifically about extra help. Some people recognize it by its other name, the low-income subsidy. It is directed at reducing your Medicare Part D prescription drug costs, including your plan premium, your deductible, and your copayments at the pharmacy counter. Here is the detail that is genuinely worth knowing. In a great many cases, receiving approval for a Medicare Savings Program automatically enrolls you in extra help at the same time. 2 of the most substantial health cost relief programs in the entire system, both unlocked through a single phone call to one office. Let us keep moving because there are still 4 more bills to get through, and some of what is coming is going to genuinely surprise you. Bill number 4 is your phone or internet service bill. There is a federal program called Lifeline that reduces your monthly telephone or broadband bill by approximately $9.25 per month for qualifying low-income households. It is not a life-altering amount when viewed in isolation, but here is the way I want you to think about it. This is a recurring monthly bill that the system has already determined certain individuals should not have to carry in full, and it is sitting there unclaimed for the exact same reason as everything else on this list. You only receive it if you actually submit an application. Certain states layer an additional discount on top of the federal base amount. And if you are a homeowner who qualifies, the Affordable Connectivity Program may also apply to your situation. Stack several of these smaller items alongside the larger ones we have already discussed, and your total monthly outflow begins moving in a genuinely meaningful direction. Heating a home through winter and cooling it through summer. For a large number of retirees living on fixed incomes, energy bills represent one of the most unpredictable and stress-inducing line items in the entire monthly budget. There is a federal program called LIHEAP, which stands for the Low Income Home Energy Assistance Program, and it helps cover those utility bills directly. Funding flows from the federal level down to individual states and then out to qualifying households, with eligibility determined by income level and household size. Contact your local community action agency or your Department of Social Services to find out the specific application process in your area. This particular one varies considerably depending on where you live, which is precisely why most people never hear about it. But in a number of states, once you reach 65 or older, your annual vehicle registration fees are either reduced substantially or waived entirely. Some counties offer comparable reductions on local licensing and permit fees as well. Some states provide free or heavily discounted admission to state parks, museums, and recreational facilities for senior residents. None of these represent enormous sums individually, but not a single one of them should be leaving your pocket if the law clearly states they do not have to. The action required here is a single call to your state's Department of Motor Vehicles and to your county clerk's office, asking specifically what senior fee reductions currently exist and how you go about applying for them. This next one differs somewhat from the others, but it matters considerably. A significant number of seniors are currently paying accountants or commercial tax preparers for basic returns that could be prepared completely free of charge by IRS-certified volunteers. Two programs exist specifically to address this situation. One is called Tax Counseling for the Elderly, abbreviated as TCE. The other is AARP Tax Aid. Both are staffed entirely by trained and IRS-certified volunteers. Both programs will sit down with you, prepare your complete return, and file it without charging you anything at all. And critically, these volunteers specifically know which senior deductions to look for in your return. They are not rushing through an enormous stack of returns the way a paid preparer at a high-volume firm during tax season might be. If the expense of obtaining professional assistance has been part of what has kept you from addressing any of this, that particular reason no longer exists. If you own your home outright and have accumulated some meaningful assets, there are two additional provisions worth understanding. Because for the right individual, those two alone can be worth more than every other item on this list combined. The first is property tax deferral. In a number of states, once you reach a qualifying age, you can apply to stop paying your property tax bill entirely while you remain alive and living in the home. The unpaid taxes accumulate over time and are settled later when the property is eventually sold or transferred to your heirs. You preserve your monthly cash flow right now while you need it most. Your heirs handle the outstanding balance at a later time. It is not the appropriate choice for every situation, but for someone who is house rich and cash constrained, it can dramatically transform the quality and texture of everyday life. The second is the surviving spouse exemption carryover. When one spouse passes away, the senior exemptions and the assessment freeze do not automatically transfer over to the surviving spouse. In many states, families lose these protections entirely by accident, and the property tax bill increases sharply at precisely the worst possible moment. But if the correct paperwork is filed in a timely manner, the surviving spouse can frequently carry those protections forward without interruption. This is one of the most consistently overlooked provisions in estate planning for ordinary families, and it is exactly the kind of situation where knowing about it well in advance is worth an immense amount compared to discovering you missed the window after the fact has already passed. Let me bring everything back to a real human situation because raw numbers only communicate so much. I want you to picture a woman I will call Dorothy. She is 74 years old. She lives alone in a fully paid-off home that she and her husband purchased together many decades ago. That home is now worth nearly 3 times what they originally paid for it. She gets by on Social Security income and a modest pension. She has been preparing her own tax returns for many years and considers herself a reasonably organized person. When someone finally sat Dorothy down and carefully examined her complete financial situation, here is what they discovered. She had been paying a Medicare Part B premium that her state would have covered entirely under a Medicare Savings Program she had simply never been told about. She had no senior exemption or assessment freeze on file with her county whatsoever, which meant she had been watching her property tax bill climb higher every single year, even as her income remained essentially flat. And her tax return had never once applied the age 65 additional deduction she was entitled to. So she had been overpaying the federal government year after year while receiving absolutely nothing in return for that extra money. 3 separate gaps, each one completely invisible to her. No overdue notices arrived. No alarms sounded anywhere. Just money quietly leaving every single month that was never legally required to leave in the first place. 3 completed forms and 1 phone call later, nothing about Dorothy's actual life had changed in any dramatic way. She did not relocate. She did not sell anything. She did not make a single major financial decision. The only thing that changed was the number appearing at the bottom of her monthly bank statement. That is the entire point of everything I have walked you through today. Being legally entitled to something and actually receiving what you are entitled to are 2 completely different realities. The space between those 2 realities is not dishonesty, and it is not confusion. It is simply a form that has not yet been filed. And nobody whose job centers on collecting your money is going to hand you that form without being prompted to do so. So here is precisely what I want you to do during this week ahead, and none of it will cost you a single dollar. First, call your county assessor's office. Ask specifically by name whether the homestead exemption, the senior exemption, and the senior assessment freeze are all currently on file for your property. If any of them are missing, ask for the required form and the applicable deadline. Second, call your local SHIP office. Ask them to screen you for a Medicare Savings Program and for extra help with your prescription drug costs. 1 call, potentially 2 significant benefits unlocked simultaneously. Third, the next time your tax return is being prepared, before you place your signature on it, confirm that the standard senior deduction and any applicable bonus deductions for your age group were actually applied, and ask whether your withholding should be adjusted so you stop prepaying the government unnecessarily. Fourth, look up Lifeline, LIHEAP, and any state senior fee waivers that apply in the state where you currently live. These require a bit of research to locate, but the research is absolutely worth doing. And fifth, if cost has been the reason you have not had your taxes properly prepared, search for TCE or AARP tax aid in your local area. Completely free, IRS-certified, and staffed by people who know exactly what to look for in a senior return. A handful of phone calls and a small collection of forms. That is the complete distance between where you currently stand and where your money genuinely belongs. One important note before I let you go. Everything I have taken you through today is intended as general education only. It is not personal, legal, tax, or financial advice of any kind. The rules governing every one of these programs vary by state, by county, and in some cases by individual income level and asset situation. Before you take action on anything covered here, please verify the specific details with your county assessor, your SHIP office, your state's tax authority, or a qualified professional. And if something in this video was genuinely useful to you, do one simple thing. Send it to one person you know who is 65 or older. It costs you absolutely nothing, and it might put real money back into the pocket of someone who has been quietly overpaying for years without ever knowing it. I will see you in the next one.